Hi there, I am Debola Ajayi, popularly known as the Strategist. Welcome to my channel, The Business Toolkit for SMEs. Please ensure to like, share, and subscribe, as I'm sure someone in your community will do well with some of the things that we talk about. In today's class on The Business Toolkit for SMEs, I'll be talking about pricing. Pricing is arguably the most crucial thing in being able to close that sale, in being able to get that purchase, and in being able to increase your revenues. Very and extremely important. It is one of the major things, if not the major thing, that every consumer, every buyer considers, either in terms of, is this price too high, or is this price too low, or is this price high enough? Pricing. You must get it, you must understand it, you must present mastery over it to grow the revenues for that business. So let's go into today's class as we talk on pricing. Pricing. In theory, the economic underpinnings of price are fairly simple. In practice, they are more subtle due to multiple effects of price on profit. At the first level, profit drivers are sales revenue and cost. The sales revenue is in turn price times the sales volume. Now, costs have some variable and some fixed components. We looked a bit about cost at one of the other sessions. Variable costs change, as you can imagine, with the sales volume, but fixed costs do not. Pricing's critical nature is readily seen by the dramatic impact its effective management can have on the bottom line. Pricing researchers have noted that the fastest and most effective way for a company to realize its maximum profit is to get pricing right. The right price can boost profit faster than increasing volume will. There are 4 profitability drivers for every business: volume, price, fixed cost, and variable cost. So the first thing we're going to consider is, why is pricing complex? Some research conducted a couple of years ago across marketing managers has shown that pricing is at the top of the list of the issues they are facing in a day-to-day business. It seems that pricing generates a lot of headaches for them. The question is, why is this the case? The first reason is that pricing has to be in sync with the other piece of the marketing mix. The marketing mix consists not only of price, but focuses as well on product, on place, and on promotion. We can't take pricing decisions in isolation. We have to take into consideration as well the product we are selling, the product we are producing, where we actually sell this, and what kind of promotion we use in order to communicate to our customers. The second reason why pricing is perceived as being so complicated is that within organizations, there might be very different objectives when pursuing or trying to set the right price. As you know, organizations consist of different departments or different functions that might include the marketing department, the finance department, the production department, and we shouldn't forget, obviously, the department of the CEO of the organization. All of these different departments or functions might have very different objectives when it comes down to setting the right price. And this is the reality. The production department typically will favor a slightly lower price in order to drive volume and increase the efficiency of the production facility. Marketing typically favors a higher price to reflect a premium quality of their product. The CEO typically is concerned about market share, right? The last reason why pricing is perceived as being so complex is that we typically don't only set one price, but very often we have to set multiple prices. We'll then also look at pricing approaches. Now, generally speaking, we can distinguish as about 3 different distinct approaches to price setting. 2 of these approaches are external in nature, while one of them is internal in nature. Now, when we look at the internal price setting approach, what that is typically called is the cost-based pricing or cost-plus pricing. What we essentially are doing is we use the information about the cost structure of an organization in order to set the prices. So that's the internal approach to pricing. On the external side, we can distinguish between 2 approaches, what we call the customer-based pricing approach and the competition-based pricing approach. As these names already imply, we are using, in one case, information about prices set by the competition in order to identify the optimal right price for our product or services. While in the customer-based pricing approach, we are trying to extract information about the willingness to pay from our customers. My recommendation typically will be to go through a 4-step process. Ideally, to conduct the cost-based pricing approach, the competition-based pricing approach, as well as the customer-based pricing approach. All 3 pricing approaches might give you different recommendations about what the right price is. Hence, the 4th stage is really working with the information gathered and figuring out what the right price might be. So I want you to capture this a bit more closely, right? Now, what are these steps? The steps are: number 1, determine demand. Number 2, estimate cost. Number 3, analyze the competition. And number 4, select your price. Now, let's look at each approach in a little more detail. Cost-based pricing, right, is historically the most common pricing procedure. Remember, I also said it's also cost plus pricing because it carries an aura of financial prudence. According to this view, financial prudence is achieved by adding a markup to the cost of a product to arrive at the sales price. Now, in theory, this is a simple guide to profitability. Let's illustrate this using a very simple example. Imagine that your company has been developing a new printer that will streamline many processes for your small business customers, and your job is to determine the price of the printer. Now, after doing some research, you determine that the best method for pricing the printer is the cost-based or cost-plus pricing method. When considering all the expenses like supplies, production cost, marketing expenses, you determine that each printer will cost, say, about $78 to produce. If you sold the printer at $78, your company will break even. So that's good, meaning you will not lose any money. But no company is in existence to just not lose money. Everybody also wants to make money. You also want to generate profits. However, your company definitely plans to make some money from the sale of the printers, like I just said. So, in fact, the goal is to earn a margin. So it's not just about making money. There's a goal, there's a margin, 25% on each printer. Adding this 25% margin on top of your cost of the printer of $78 results in a final sales price of $97.50. This allows the company to recoup the cost of producing the printer while earning a 25% profit margin on each unit sold. Looks straightforward, right? However, there's a fundamental issue with cost-based or cost-plus pricing. In most industries, it is impossible to determine a product's unit cost before determining the price. Now you're going to ask yourself, why? Because unit costs typically change with the volume being produced. This cost change occurs because a significant portion of costs are typically fixed and must somehow be allocated to determine the unit cost. Unfortunately, because these allocations depend on volume, which changes with changes in price, unit cost is somehow a moving target. Let's again illustrate this using our printer example. Now, with some more details regarding the cost structure. Let's assume more specifically that the supplies, or we could call them as well the raw materials of producing the printers are $28. Total cost of production, $3 million. Cost of marketing, $2 million, making a total of $5 million. Before we said that the cost per printer is $78. In order to arrive at that number, we also assumed that we are going to sell a total of 100,000 units or 100,000 printers. How would now the cost per printer and hence the price per printers change if we're to sell, say, only 50,000 units? The resulting price will now jump to $128, or said definitely an increase in price by more than 30%. The problem with the cost-based pricing approach is that it mistakenly assumes that customers base their willingness to pay for a product on how much it costs to produce it. Costs, however, have very little to do with charging for a product. Instead, customers choose the price they are willing to pay based on the value that they receive from a product. Let me finish this module with an old proverb that says, cost is a matter of fact, price is a matter of policy. We'll look at the next way to set price, competition-based pricing. Competition-based pricing is a pricing method that utilizes competitive prices as a benchmark, rather than setting a price based on our company's cost or the value perceived by customers. What we typically have to do is, well, we first have to identify a relevant set of competitors, right? Once this has been done, we collect information about the prices that they are charging in the market. Then we have to figure out whether we want to match the prices of our competition, charge a higher premium, or whether we want to undercut our competitors with respect to price in the market. Let's illustrate this using an example from the car industry. Let's assume that you are the marketing manager of a new product to be launched, let's say, in the European market, right? You've already done the exercise of identifying the relevant competitors and their respective prices. You only now have to decide what is the appropriate or correct price. What we obviously see is that it's not really that straightforward. And I will show you how it's really not as straightforward as it sounds. Now, assuming you discover a price structure of 23,700 euros, 22,000 euros, 19,850 euros, 18,700 euros, 17,000 euros, 16,000 euros. We could go for the midpoint, for instance, which would be about 19,850 euros. Instead, we could go for the average of all the competitors identified, which will be slightly lower. It will be about 19,483 euros. Or should we maybe instead go for the highest price among all our competitors? Maybe considering our brand, we might even want to break out of that price range and establish ourselves as the new premium player in the market. While we have seen that, theoretically speaking, competition-based pricing is fairly simple, is fairly straightforward. We actually see that the devil is in the detail and that it might still be challenging to identify what the appropriate price is. Competition-based pricing creates additional challenges beyond the one we have just seen. It assumes also that all our competitors in the market are well positioned and have already figured out what the adequate price for their products is. And that's another assumption that comes with that approach that might be inherently incorrect, because really, when you're trying to benchmark yourself against the competition, you have assumed that the price the competition is working at is good for the market. How do you know? The next approach is customer-based pricing. Price is the economic sacrifice a customer makes to acquire a product or service. Customers always compare this sacrifice with the perception of the product's value. Hence, price and value are the cornerstones of every economic transaction. A customer buys a product or service only if its perceived value is greater than the price. If selecting from several alternatives, the customer prefers the one offering the highest net value or the greatest difference between perceived value and price. A schematic often used to capture this relationship is called the value pricing thermometer. Let's assume that a customer's perceived value or willingness to pay for a lemonade is $1. If the price is less than $1, the sales volume to this particular customer is equal to 1. If the price is higher than $1, the resulting sales volume is obviously 0. All pricing situations essentially reduce to this very simple model, the atomic building stone of pricing. On a sustained basis, the question now becomes, what determines a consumer's perceived value or willingness to pay? Obviously, the product itself is an important factor. Most of us will typically pay much more for a car than for a wristwatch. For a given product category, willingness to pay depends also on the product's features, quality or performance or benefits. Thus, we'll typically pay more for a Mercedes-Benz than for what? Say, a Skoda. The willingness depends also on alternatives available to the consumer. Willingness to pay is typically lower if cheaper alternatives are available from competitors in the market or in the form of substitutes. Finally, the consumer's preferences for the product are determined by his or her disposable income and taste. A consumer will buy a product only if his or her willingness to pay exceeds the price being charged. That's the reality. Typically, not every consumer is alike. So when we look at an entire population of consumers, we will typically see that they are very different or heterogeneous. As a consequence, it follows that only a subset of consumers will buy a product at a given price. Let's illustrate this using a very simple example. Let's imagine again that you are the marketing manager of a car manufacturer. If you charge a very high price for your car, the reality is only a very small number of customers will have a willingness to pay that exceeds that price. And as a consequence, the demand will be small or fairly limited. On the other hand, if you would reduce this price quite significantly, you will see how the number of consumers out there on the market that have a willingness to pay that is higher than the specified price increases or augments. So as a consequence, the overall demand for your product increases as well. So generally speaking, we see that having a high price typically leads to a small demand, while a very low price leads to a fairly high demand. In considering your pricing strategy, you really will have to take these three approaches and the 4 steps mentioned earlier into consideration. Why? Because you must understand your cost in ensuring that your price per unit is set at the marginal point for your cost. You must also understand that your price in comparison with your competitors positions you in the market already in the mind of the customer. So you must be aware of this. You must understand what your price is telling the customer, because the customer most of the time is comparing prices amongst several options. And number 3, the customer value approach. Remember that the customer is also going to assess your price based on its perception of your products or your services value. So these 3 approaches are crucial in arriving at your final price. So you can take these 3 approaches and call them 3 perspectives, 3 windows through which you look at the soul of the business. The price is a point that every customer touches the business at before making that buying decision. And you must understand the model to use in pricing your product or service in that market so as not to unknowingly chase away prospects and reduce your revenue generating capacity or capability. I hope you've been able to learn a few things in today's video. As usual, please like, share, subscribe. Someone in your community definitely needs this. Again, I'm Debola Ajayi, popularly known as The Strategist. See you in the next edition of the Business Toolkit for SMEs. Thank you.